the basis for an HBO documentary coming out in July. Ashley is a super busy dude. He is with us. Ashley, good to have you here. Ilya, one of the big ones when we talk about AI, remind everyone why he is so important and why we follow what he does.
Yeah, I mean, he's maybe the biggest. He starting around 2012 when he was a researcher, he really kicked off some of the most important breakthroughs that started this modern AI race as we know it. He went on to work at Google and then co-founded OpenAI, and it was really just the presence of Ilya being at OpenAI that made it kind of a real thing and attracted all these other researchers. And then, obviously, since then, OpenAI went from this underdog to overtaking everybody, and a lot of people attribute Ilya's insights to that success.
But no longer at OpenAI. What do we know, before we get to what he's working on now, what do we know about his departure from OpenAI?
We don't know a ton more. He was involved in the original ousting of Sam Altman as CEO. He was on the board of OpenAI at the time and originally sided against Sam, and then he was instrumental in bringing Sam back just a couple of days later. And ever since then, he's been in this state of limbo. It was unclear, was he going to join the company? Was he upset by things? Where did things stand? And that went on for several months until mid-May when he issued a tweet and he said, look, I am leaving OpenAI. There didn't seem to be bad blood, but he said, I'm going to do, my own thing next. And we haven't known what that was going to be until yesterday.
All right. So tell us about Safe Superintelligence. This is his new venture. What do we know? What did you find out?
Yeah, I mean, it's kind of incredible. So in AI industry lingo, people have been chasing this AGI, an artificial general intelligence that's usually described as basically human level or a little beyond human. What he's going after is this super intelligence. This is beyond human capabilities. To be clear, nobody actually knows how to build this yet, and we don't even know if it's possible. But he's put a flag in the ground, and he said, look, I'm going to build this thing, and the key here is that he said he's not going to sell products and services along the way like all of the other companies. He sees this as a conflict for them, and so he's just like going into a cave, and he's going to emerge with this super intelligence.
Okay, not selling any products or services, at least in the near term. That sort of maybe is a good segue to talk about how he thinks philosophically about for-profit, nonprofit, and the role of a research organization and how it sort of collides with a for-profit organization.
Absolutely. He named this company Safe Superintelligence Inc., which, some people have maybe a giggle at, but, he's making safety to be this priority, and he clearly thinks that if you have to make products, you've got these other, masters to cater to and conflicts that arise from this, and that the only way you could really make a safe AI, which again, we don't really know how to do, but if you were going to try to do it, you'd have to do it unfettered by all these other conflicts. And he said, he admits that we don't really know how to do this yet, but he's famous for coming up with breakthroughs in this field. And he said that's what he's going to try to do here around not only making this new form of intelligence, but adding actual engineering into it to make it safe.
All right, Ashley, cue my sarcasm. So I can see the pitch to investors. Hey, guys, I'm going to do this really super intelligent AI, and we're not going to make any products or services. So I don't know how we're going to make money. But hey, we're going to do this. Give me money. Give me money. I mean, who's funding him?
It's a bold pitch. There's not many people who could get away with this.
That's true.
I think we don't know exactly who's funding him yet. And normally, my skepticism radar would go off pretty hard, but I suspect they will not have trouble finding money. I mean, this is the guy who's probably the most famous AI researcher in the field saying, I might create the one product to rule them all. If you want to go on this adventure, come with me. And so I suspect they'll find money. But the amount of money we're talking about here is dramatic. To build these models today, you're talking about 1 billion to tens of billions of dollars of pure compute power that you need. And so, this will be quite the gamble for whoever takes the ride.
Well, let's go to the heart of this and the safety concerns that researchers have had when it comes to AGI. How would you summarize the way that Sutskever thinks about safety in AI and AGI, and what are his biggest concerns?
What's interesting, he's kind of like so many people in this field. He has been tweeting for years that he is concerned about where AI is heading, how powerful the technology is, what it could do to humanity, and yet, like almost all of these people, he's chasing it as fast as he can. So, this has been top of mind for him for a long time. If you look at the major AI players today, they all talk about safety. We can have an argument of how serious these discussions are. A lot of times these models get built and then you try to tame them after the fact. He seems to be saying, look, we need something like a kill switch or something embedded in this code where you could turn this thing off if it was going wrong. And nobody's figured that out yet, even though intellectually people have talked about this for decades. Nobody's actually done it. And so I think that's the difference he's trying to make. He hasn't said a lot, so you're kind of parsing what we can out of his words.
I feel like you need a 23andMe in the AI space to kind of connect all the players who are kind of connected. Because I want to bring in Elon Musk. We were just talking about him earlier, someone you know very, very well and have written about extensively. I'm just curious about how potentially maybe what Ilya is doing, and of course, Elon has raised $6 billion to kind of challenge OpenAI. He cares about, he says, safety in AI. I'm just curious how you are thinking about maybe how some of these players could possibly come together. Are they all just going to compete against one another? And work together.
It is like a soap opera. This is like they were all part of the original boy band at OpenAI, and now have kind of broken up and gone their separate ways. Ilya and Elon historically were very tight. I mean, they really were part of this kind of core that started OpenAI, and now have diverged. I cannot confirm this for sure. What I'm hearing is Elon is not going to be funding Ilya's new venture, and we did see a tweet this morning where he was kind of commenting on the name, and so it looks like he's skeptical of what Ilya's trying to do. With Grok, Elon's AI, his big push. So Elon has been afraid of where AI is going, but we haven't seen necessarily this big emphasis on safety from Grok either yet. Elon's mostly been pushing against what he sees as the political correctness of these other AI systems to date. And so I don't know. I cover this stuff a lot. I think it's all a mystery. I think people are not very clear on what they mean about safety or any of this stuff. And so there's much to be done still.
Okay, well, speaking of the original sort of boy band, Anthropic is a name we haven't mentioned yet, and that's another company that was started by former employees of OpenAI. And today they came out with some news unveiling the most intelligent AI model yet to vie with OpenAI. Where does Anthropic fit in with all of this?
They're part of the boy band. They were started by a bunch of guys who, men and women who had made GPT-3 more or less within OpenAI, and seemed to have had a fracture over where they saw OpenAI going, especially on this trust and safety stuff, and so broke off to start their own company. They've been incredibly competitive very quickly, obviously a very smart team over there. And so, yes, they just released this new model today. It seems to be doing very well on these early benchmarks. It seems like there's this race where somebody does a new model, somebody else catches up quite quickly, and nobody is lightning years ahead. Anthropic's big thing has been that they take safety perhaps more seriously than anybody else, and that's been kind of baked into their DNA and the things that they say. Again, it's not totally clear how that manifests itself in the engineering of the systems.
All right, because you're you. HBO, documentary. This has got to be exciting. Can you tell us just real quick?
It's really exciting. Yeah, thank you. So next month, July 17th on HBO, we have a documentary coming out called Wild Wild Space. It's all about the rise of commercial space. I spent 6 years with a camera following a bunch of rocket companies and satellite makers around. It's co-produced with Steven Spielberg's Amblin and Adam McKay's Hyperobject. And I think just asking people to tune in next month when it airs. And I think it's a really interesting, unusual look at startup life, the rise of commercial space. We had cameras in when rockets were blowing up, in the mission control. You get to see how people react to that. So it's been a fun journey.
All right. Great stuff as always. Looking forward to that. That's coming out, as we said, HBO documentary in July. And then we're going to look forward to the boy band AI summer tour documentary that you're going to do, because at some point that's going to happen as well. Ashley, thank you so much. Really appreciate it and get some time with you. Ashley Vance, he's Bloomberg Business Week features writer. You can check out Ashley's story on the Bloomberg and, of course, at Bloomberg.com/businessweek.
All right, stocks mixed on this Thursday afternoon. The Dow up 0.9%. The S&P 500 down just about 0.1%, while the NASDAQ down just about 0.6%, Carol.
All right, straight ahead, from a deadly mining complex that's part of the Green Revolution to the companies that pledged to back out of Russia but kind of didn't. The new monthly issue of Bloomberg Business Week. That's coming up next. This is Bloomberg Radio and TV.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices, and if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. A decidedly mixed U.S. stock market right now, with the Dow powering higher, just about the best level of the day right now on the Dow Jones Industrial Average of 353 points, a gain of 0.9%. S&P, though, losing traction after a rally to a record earlier in the session, getting above 5,500 briefly as calls for a near-term pullback increase amid signs of buyer exhaustion. Right now, we have got the S&P 500 index down 5, 54.81, drop right now of 0.1%. NASDAQ down 110, decline there of 0.6%. 10-year 4.24%. We've got the 2-year yielding 4.72%. Spot gold up 1.4% at $23.59 the ounce, while West Texas Intermediate crude oil up 0.7%, 82.13 right now for a barrel of West Texas Intermediate crude. Amazon is shifting from the plastic air pillows used for packaging in North America to recycled paper because it is more environmentally sound, and says paper works just fine. Amazon up right now by 1.1%. Again, recapping mixed day for the U.S. stock market. S&P down 5, down 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks for the update. Carol Massar along with Tim Stenovic live here on Bloomberg Business Week. Well, for decades, every week, Bloomberg Business Week taps into the top stories in the worlds of business, technology, politics, economics, culture, and so much more. You know, the stories everyone is talking about, the stories shaping our investment world and really, Tim, the world at large.
Well, that continues along with a monthly Business Week issue. It kicks off next week, and here to talk about it, the editor of Bloomberg Business Week, Brad Stone. He joins us from San Francisco. Brad, the author of Amazon Unbound, Jeff Bezos and the Invention of a Global Empire, among other books. Brad, good to see you this afternoon. A monthly, that's what I want to talk about, the relaunch here. How does that change things editorially? How does it make you think differently about the cadence here?
Yeah, thanks, Tim and Carol. And of course, you guys are a big part of the relaunch. In some ways, not a lot is changing. You know, Business Week, despite the name, has been a daily for years. You know, we publish online on all Bloomberg digital properties, on the Bloomberg terminal. We publish on Apple News Plus, and that's not changing. You know, the quantity and quality of Business Week stories and the fact that you can find them online every single day is not changing at all. You know, the print magazine is, as of next week, becoming a monthly. I would say as a monthly, the fact that we've got 12 issues a year, it means that our ambitions are higher. They're greater. The kinds of stories we're telling, the kinds of people and companies that we're putting on the cover, we're going to be absolutely certain every month that they are the companies and the people that are making a difference in global business, and where we can not just ask but answer questions about what they're doing and how they're doing it.
Gotta say, Business Week has always been one of those things that is kind of out there ahead of everybody else, and it's like all of a sudden we've been talking about it, you guys have been talking about it, and then everybody plays catch up, to be fair. Having said that, how did you guys think about this first monthly issue? And as you said, you're publishing daily, so stories are constantly coming out, but when you think about a monthly and what you wanted to put in the actual publication, how did you kind of address that?
Yeah, and Carol, I cannot wait to come back next week and talk about the first cover story, because essentially we asked, you know, who is not just one of the most powerful people in the world, but what are the business figures that is perhaps the least understood? And that's the first cover story of the July issue of Business Week, and we'll talk about that next week. But we've also included in the magazine some of our most ambitious and aggressive investigative journalism. So we've got a story from two of our Singapore correspondents, our editor Matt Campbell, our metals correspondent Annie Lee, and they visit Indonesia and the island of Sulawesi, where there are mining facilities that are basically refining nickel, a commodity that goes into many of the world's batteries and is key to the supply chain of electric vehicles. And they chronicle, you know, just a litany of almost jaw-dropping, not just environmental abuses, but worker abuses at these facilities in Sulawesi, in particular, a kind of mining community called the Indonesia Morowali Industrial Park, or IMIP. And it's just hair-raising stuff. It will make you think differently about the global supply chain, about some of the components that are going into the world's batteries. And, it's really representative or characteristic of the kind of storytelling we're trying to do in the new Business Week, not just the profiles of the companies and executives who we all know and wonder about, but reaching deeply into the world of global business with some of our best investigative reporters in the Bloomberg newsroom to tell those surprising stories.
Yeah, and kind of the conflict of what is green, right? Like you think EV, right? Great for the environment, like this whole idea, this big push globally. But then when you get into kind of something like the battery production or where the supply chain, what are the sources? Is it responsible? It's not necessarily playing out that way.
Well, I mean, look, we want to be clear-eyed about this. Electric vehicles are, bottom line, better for the environment. I think that a lot of the car companies, and we represent their viewpoints in the story, recognize that the nickel production, particularly in the first generation of electric vehicles, there was a pretty bad environmental and worker and labor record there. And they've tried to, I think we see that, for example, subsequent models of Tesla do not rely on the same quantities of nickel that previous models did. So there is a recognition. It might be somewhat belated, but with this story, we really kind of lay bare one of the ugly dimensions of the supply chain.
Okay, well, speaking of the complexities of global business, a few years ago when Russia invaded Ukraine back in 2022, a lot of businesses that are based in the United States pledged to stop doing business with Russia, stop selling their products in Russia. One of those was Coca-Cola, Brad. In the upcoming issue of Bloomberg Business Week, you dive into the complexities around doing that because, hey, you can still get a Coca-Cola in Russia.
That's right, Tim. We in the new magazine, readers will find that there's a whole new front of the book, and the first section that you'll encounter we call In Context. And they're shorter stories, lots of kind of graphical presentations, photo heavy, some interview franchises that we're developing. But then we're just kind of asking and answering some basic questions. And we did wonder, so after the 2022 invasion of Ukraine, when all those U.S. companies pulled out, like how real and how permanent was that? And the observation that came back from some of our reporters in Russia and in Eastern Europe is, you can still find suspiciously red cans and bottles of soda. And the answer is, Coke in particular is widely available. It's getting imported from neighbors like Kazakhstan and Georgia. And then the bottlers, through some complicated kind of corporate ownership structures, have essentially renamed their soda. And I think in Russia now, where you can still find Coke or the offshoots, it's called Dobry Cola, and essentially it's the same thing. So some I guess maybe the commitments were a little soft, and we've seen them get softer as the invasion goes on.
And not just Coke, there are a few others, right?
Oh, absolutely. I mean, Coke obviously is the icon, so we looked at it. But when you go through lots of recognizable American franchises, starting with Pepsi, also you can get either imported versions of it or their suspicious offshoots.
All right, so let's get to one other story that's in there. And I feel like as we are dealing with another heat wave here in New York City and a big chunk of the country, communities that are dealing with it and how they have to kind of change their strategies, especially when it comes to fire and fire mitigation plans.
Yeah, so this is a collaboration between Business Week and Bloomberg Green. We have a section in the new magazine that we call In Depth, which is really a part of the magazine for packages of stories. And we asked Bloomberg Green to help us look at how cities are adapting to climate change. And so we look at cities like Sao Paulo that's developing these kind of spongy rain gardens to deal with the increase in precipitation. And then Boulder, Colorado, which is pushing a new agenda, junk your junipers.
Gasoline July futures settle at $2.50. Diesel July futures settle at $2.52.
And wildfires. And so there's all sorts of campaigns.
Natural gas July futures settle at $2.74.
Cut them down, remediate forests, or even entrepreneurial efforts to create kind of new kinds of mushrooms or fungi that will draw the moisture from some of these forests. And we see cities like Boulder really increasing the budgets for climate resilience. I think it was $4 million a year to now almost $7 million, or 2% of the city's operating budget. So cities really at the front line of trying to address climate change.
And I think what's complicated in the tension in this story is that Boulder's a place that
And
people
NYMEX
live
WTI
to,
crude July
because of its
futures settle at
proximity to the
$82.17 a
outdoors,
barrel,
to do cycling, to
which
go
is up
climbing,
60
to
cents
go
or
whitewater rafting.
0.74% on the session.
These areas of the country and of the world that increasingly are presenting the biggest risk when it comes to fires as a result of a climate that is getting warmer, Brad.
Yeah, and it's probably a paradox of living in a place like Boulder. You seek the outdoors, and yet every time it gets real hot, or the winds start to blow, we have people in the story talking about just anxiety levels shooting up because they've had some really near misses over the past couple of years, and I think they recognize they're on the front line of recognizing that they cannot wait for the disaster to come to them, that they have to engage with their environment and look at it in a new way and be aggressive in trying to stem the threat from climate change. It's one of those communities that's growing so quickly that it has really spread out into natural habitat that probably weren't meant for this kind of development. So Boulder is a great example of how cities are being aggressive in taking some steps to prevent the worst from happening.
Well, Brad, looking forward to the new monthly issue of Bloomberg Business Week when it comes out, and to the cover story. You definitely have us intrigued. So thanks so much for stopping by and chatting with us. Brad Stone, he's Bloomberg Business Week editor, joining us from our bureau there on the West Coast. Hey, and coming up a little bit later on in the, I think the 4 o'clock hour, we're going to explore another story in the upcoming new issue, monthly issue of Bloomberg Business Week, and it gets into how Liberace and Elvis set the stage for Celine, Elton, and Adele.
In Las Vegas.
In Las Vegas.
Yeah, it wasn't the Sphere that brought everyone there. History.
No, exactly.
You got to go back in history a little bit. Hey, in the meantime, all that and more ahead. In the meantime, let's get a check on the latest world and national news. Right, Amy Morris in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Amy.
Hi, Tim. A high-level meeting with Israeli officials was canceled by the White House after Israeli Prime Minister Benjamin Netanyahu posted a video claiming that the U.S. is withholding military aid. National Security spokesman John Kirby said no other country supports Israel's defense as much as the United States.
It was perplexing, to say the least, certainly disappointing, especially given that no other country is doing more to help Israel defend itself against the threat by Hamas and, quite frankly, other threats that they're facing in the region.
The White House denies the allegations, saying military aid continues to Israel, except for one shipment of 2,000-pound bombs. The Supreme Court has upheld a tax on foreign income. It did not weigh in on a broader, never-enacted tax on wealth. The law includes a provision applying to companies that are owned by Americans but do their business in foreign countries. It imposes a one-time tax on investors' shares of profits to offset other tax benefits. Treasury Secretary Janet Yellen says former President Donald Trump's proposed tariffs would raise costs for consumers and weigh on American businesses. Yellen defended President Biden's decision in May to impose new tariffs on Chinese goods to protect U.S.-based manufacturers in industries that the administration deems critical, like semiconductors and clean energy. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as, moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
Saturday mornings, I understand you have off.
Yeah, Saturdays is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We got the Dow pushing higher, the S&P, NASDAQ, both in the red. Stocks losing traction after a rally to records spurred calls for a near-term pullback amid signs of buyer exhaustion. The S&P now lower after briefly topping 5,500. Right now, the S&P 54.79, down 7, down by about 0.1%. The Dow, though, up 361, very close to session highs, up 0.9%. NASDAQ down 118, a drop of 0.7%. 10-year yield right now 4.24%, with a 2-year that's yielding 4.72%. Gold up 1.4% now to $23.59 the ounce, and West Texas Intermediate crude up 0.7%, $82.17 a barrel. Dell Technologies lower after CEO Michael Dell said the company is building a Dell AI factory for Elon Musk's startup xAI alongside NVIDIA. Musk responded to comments about the post, saying Super Microcomputer will also be providing servers. NVIDIA down now by 2%. Dell shares trading higher now, just rebounding a little bit, up 0.2%. Super Micro up by 0.6%. Recapping, S&P down 6 right now, drop of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Some big moves in Supermicro and Dell.
Yeah.
Kind of big rally.
You think they're going to be gainers for later today.
Had to cross it off my list.
Got to cross it off your list.
They were on, then they were off.
Well, I'm not putting them as decliners.
Okay, I know. We're just going to back off. All right, we want to get to our next guest. Deja vu all over again when it comes to stocks. So says our next guest as the S&P 500 takes out another record. But again, we were above 5,500 on the S&P 500. We've pulled back. The NASDAQ 100 was headed for another record. We've pulled back. So that is your Thursday in a nutshell.
Well, we got back with us in the studio, Jeff Crumpelman, Chief Investment Strategist and Head of Equities over at Mariner Wealth Advisors out of Cincinnati. Jeff, good to have you back with us. The S&P 500, so far this year, we're only halfway through the year, not even. It's already achieved your 2024 target range. It's actually surpassed it because that was 5,200 to 5,400.
In a big way.
Brent crude futures settle at $85.71 a barrel. It's up 64 cents or 0.75%.
All over again because we were at the same place last year. We had that nice rip-roaring market through July and surpassed our target of the lower end of our target of 4,500. By the midway point, and people kept asking, are you taking your target up? And it was a different environment because that was a contrarian view in 2023. And our answer was no, but we do think the trend is still positive longer term, and active management can add value. Same thing this year. Same thing this year.
So longer term, you mean next 6 to 12 months, or you're saying like 5 to 10 years from now? Like
No.
So what are you saying longer term?
So I think in 12-month, rolling 12-month increments.
Yeah.
So what we do is introduce our crystal ball at the beginning of each and every year. We tell people exactly where we think it's headed, why it would go there, and then what could go wrong and make us adjust our view. And we revisit that at halftime, middle of the year, and look out another 12 months. Seldom do I do a lot unless the environment's changed significantly to adjust that year-end target.
So you're not upping it at this point?
No, absolutely
not. But you're
not.
not reducing it either?
Not reducing it. And I do think that the trend is, up if you look over the next 12 months. There, you mentioned, today that I think just the tape play there was that perhaps there's a little buyer exhaustion. We've got an election coming up. We've got a lot of things that could just annoy people temporarily. We all get crabby, and we're not good enough.
No, we never get crabby.
Hangry. We get hangry.
Except for you guys.
We do get hangry.
Yeah, that's true.
A lot.
I get hangry too.
Yeah. So maybe people get grumpy or annoyed by the election, but is there anything bigger that you should have perhaps on your radar?
U.S. money market fund assets rose $21.56 billion for the week ended June 18th, according to iMoneyNet.
October of 23, the number one risk item on our radar would be rates. And they're calming, they're stabilizing. But when we made that push up to above 5% last year in the fall, that made us nervous. And if we would have adjusted our view, it would have been that. What would have done that? Bond vigilantes that would have been nervous about inflation and just, Treasury supply demand at those auctions and, worry about enough buyers coming in where we got record levels of debt. That all seems to be kind of stabilized. Inflation is calming. Supply demand in these Treasury auctions are, positive, constructive. And so we think that what will get the headlines is earnings, still very resilient economy. And as we move through the end of the year, boy, oh boy, if we do get a Fed rate cut, and we kind of stand away from all this rhetoric about what will the Fed do.
But if we don't, it's okay. You'll hold to your guns, if you will, in terms of your S&P 500 target.
Yes,
even if we don't get a cut this year.
Even if we don't get a cut, and I think that they are in a very good place right now because we're not on the cusp of recession. And inflation really is calming. And I think, I know how it is when we're in a meeting and we're getting ready to put out a big report. If you come in hours before that report is just ready to be printed, and you give me some data that, I could probably tweak it, generally you just kind of go, it's okay. And they got some really good news on the inflation front before they did their presser.
I want to talk names because Kava is, you kind of have four areas that you like: consumer, healthcare, tech, and industrials.
Yeah, I'd say so.
Right? I think materials also kind of, right?
They fall in that boat.
So maybe,
Right.
Kava is one of those names, and Tim and I have talked about it, and this one is up more than 300% since that June 2023 IPO. Why do you think that there's more momentum to the upside here?
Oh, because it's so early stage. So this is like Chipotle 20 years ago. They actually got into the business by buying Zoe's Kitchen. They only have 300 outlets. They're growing units sales, or unit stores, square footage growth, 15% annually. And they're early on in introducing these new stores. So promotion expenses will go away, margins increase.
You're not concerned by the valuation? We had Bailey Lipschultz in here last week who wrote a story about how the average restaurant, the average restaurant at Kava is valued at $33 million, which is just an astronomical sum, even if you go back to the halcyon days of Chipotle early on.
I'm not worried about it in its early growth stage. We're talking about 75 to 100% earnings growth from 25 through 27. So they're just getting started. They're pushing really good top-line sales, and it's a great concept. This is Mediterranean, and you could argue there is or isn't, competition there, but they are more than twice the size of any competitor, and they're implementing and executing, expanding better than anybody else. So this is kind of like saying, are you concerned, Jeff, in small biotech about valuation? And the answer generally is no. If there's revenue momentum, no, I'm not. There will come a day that I will care about that.
But going back to it, okay, so because that's a huge. So we're kind of comparing them at similar stages, right? When Chipotle IPO'd, their stores were valued at about $3 million per restaurant. So we're looking at Kava, that's $33 million. Like, that's okay. So they're kind of at, when they were at the same stage. That is such a big difference. You're comfortable with that.
I think they're going to just grow into, earnings went up.
Grow into the growth we've already seen in the share price?
Their earnings estimates were something like, they've come up 30% for 2025 in just a couple months' time.
Okay.
So it's execution. And what is the earnings number? It's going to come up significantly. And so, yes, I feel like this is a momentum play. You got to know, different stocks trade differently. This is really a revenue story, expansion story, and that's what will make it a successful investment.
Okay, DraftKings, we don't have a ton of time left, but I do want to talk a little bit about DraftKings because in recent weeks, we've seen some legislation that could raise taxes on sports betting come from states, including Illinois. How do you think about that kind of legislative risk?
I think that they'll get more licenses in new states, and we've kind of done a little bit of checking where we could. It's not likely that we get an avalanche of tax rate increases state by state. They are so starved for tax revenue that they want this kind of stuff happening. So the story there again is pretty simple, and you got to stay on top of it. But it's the best platform. You talk to anybody about where do you really like to, place your online, bets, and they'll tell you it's DraftKings. So like Kava, stop that promotional spending. You get margin expansion, in a great addressable market.
Stay tuned. Both have had tremendous runs certainly this year. Jeff Krumpelman, thank you so much over at Mariner Wealth Advisors. Still ahead, we're going to get into the Chipotle Boy Bowl. Yes, it's a thing. It's coming up.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. A United Airlines plane had to return to a Connecticut airport this morning after losing part of a liner from inside the engine's cover. Another incident for a carrier already under scrutiny over a series of flight mishaps this year. The Airbus A320 aircraft left Bradley International in Hartford this morning en route to Denver when the crew heard what's being described as an abnormal noise. UAL down 1%. Boeing shares, they're up 0.8%. Airbus ADRs down less than 0.1%. Gilead Sciences' experimental twice-yearly shot prevented 100% of HIV cases in women and adolescent girls in Africa, the first successful big trial of what is hoped to become a powerful new drug regimen for fending off the virus. Gilead shares today up now by 7.8%. Auto retailers across the country have suffered a second major disruption in as many days today after another cyber attack at CDK Global. That's a software provider that thousands of dealers rely on to run their stores. Now, among publicly traded car dealers right now, we do have AutoNation lower by 2.6%. Group 1 Automotive down 2.6%. Lithia Motors lower now by 1.2%. Kroger sales inched up as consumers kept buying groceries and other essentials. The largest supermarket operator said comparable sales rose 0.5% last month. Kroger, which runs several chains, including Ralph's and Dillon's, is hoping to become an even bigger presence in the U.S. by buying Albertsons. Albertsons down 0.7%, Kroger down 2.8%. Those are our top company stories, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. Let's get a check on the latest world and national news. We got Amy Morris in the Bloomberg at 99.1 Newsroom in Washington, D.C. Hey, Amy.
Hi, Tim. The White House has announced it's shifting the priority of weapons deliveries to foreign countries, putting Ukraine at the head of the line to help its defense against the invasion from Russia. National Security spokesman John Kirby announced today the weapons deliveries include Patriot and SM missiles Ukraine needs for air defense.
We're going to reprioritize the deliveries of these exports so that those missiles rolling off the production line will now be provided to Ukraine.
Kirby added that delivery delays will not impact arms shipments to Taiwan nor Israel. The Supreme Court has upheld a tax on foreign income over a challenge backed by business and anti-regulatory interests. The justices left in place a provision of a 2017 tax law expected to generate $340 billion from the foreign subsidiaries of domestic corporations that parked their money abroad to shield it from the IRS. Treasury Secretary Janet Yellen says former President Donald Trump's proposed tariffs would raise costs for consumers and weigh on American businesses. But she defended President Biden's decision in May to impose new tariffs on Chinese goods to protect U.S.-based manufacturers in industries the administration deems critical, like semiconductors and clean energy. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. Now back to Bloomberg Business Week with Carol Masser and Tim Stenovic.
All right, Amy, thank you so much. All right, we want to get to our one more thing. And basically, folks, it's a Chipotle Boy Summer. So what does this mean? Chipotle is actually introducing something to a group of their constituents, if you will, that seem to be, using the Chipotle app a lot and actually eating at Chipotle a lot. So they've created something called the Chipotle Boy.
Okay, they got the data, so they know what these guys want. They tweeted it out, actually. The Chipotle Boy Starter Pack comes with a puffy vest. You don't buy this at Chipotle, but this is the starter pack, okay? Puffy vest, AirPods, some aviators, and then there's the Chipotle Boy. And for everybody wondering what the Chipotle Boy bowl is, double chicken, white rice, black beans, mild salsa, corn salsa, sour cream, cheese, guac, and lettuce.
Yeah, 2 scoops of chicken. You don't have to ask because apparently, you get like 1 scoop and they're like, can I get another scoop? But it's really interesting. And I guess it's only like limited time, as we said. You can only order it on the app, but definitely catering. And I think it plays to, remember, was it the individual, was she on TikTok?
Yeah.
And, created a song.
Don't sing it because it'll just get stuck in everyone's head.
You don't want me to sing anything. It's kind of interesting, but I feel like it means what companies are doing is they're probably looking at their customers that use them the most and saying, all right, how could we do even more for them? What?
Looking for a man in finance. 6'5".
Keep going.
Yeah, I'm not going to keep going.
Wow.
Yeah.
How come? Are you playing this on the weekends or something?
No, it's
Come
just...
on. You could tell us.
It's an earworm, as they would say.
It's an earworm.
It's an earworm.
Yeah, so very interesting. So we'll see what happens and see whether it kind of moves the needles financially.
Next time we have Brian Nickel on the program, we'll ask him if the Chipotle Boy Bowl.
We'll see if he knows.
I think there is an
interesting.
interesting.
See if he knows that theme too.
Look, I also think there's an interesting actual business and data story here, which is that Chipotle does have the data of what people are ordering on the app, and they can make changes to the menu and offer specials based on things that are popular. And this was obviously something that was resonating with a group of people, so they're making it easier to make the order.
Or it's that apparently they eat there 5 to 7 days a week.
Yeah.
And so Chipotle is like, ka-ching, ka-ching. Let's help them out here. All right. We're going to move on. I think we're done with that.
There's a Chipotle down 6.7%.
All right. Anyway, that is certainly our one more thing. Coming up in the next hour, for those watching on television, the close is coming your way in just a moment. We've got a great guest coming your way in our 4 o'clock hour. We're going to talk with Dr. Anthony Fauci. He's got a memoir out. So we're going to talk about, yes, COVID, but so much more. We're going to go back to the AIDS epidemic and the work that he did there. We've got lots of questions. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
A big bet in the futures market that says a Fed cut isn't as far into the future as some folks think. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Will we get a 30-second record close?
Well, we're going to find out in about 1 hour's time, yeah.
I know, we're just down by like 1/10. That could happen. All right, let's get a check here on where market stands. The S&P is just down 0.2% off its lows, clearly trying to make a run into neutral territory before the close. We'll see what the next 60 minutes bring, but it's really about the tech giants. Romaine will get to that more in just a moment, but you got the NASDAQ 100 selling off. NVIDIA responsible for about 48 points from NASDAQ 100. 10-year yield also minor selling off here with yields up just a touch by about 2 basis points, Romaine.
Yeah, one reason why we're seeing some softness out there is that the underpinnings for what had effectively been an 8-week rally here for U.S. stocks, starting to show some strain amid fresh economic data that shows the number of people continuously receiving unemployment benefits. That was up for a 7th straight week. And then you had a separate report out there showing U.S. home construction slumping to its slowest pace since the pandemic. More evidence out there, at least for all the haters, that higher for longer rates are indeed taking their toll on this market. It's a sentiment shared to some extent by C-suite executives, with the new survey of CFOs out showing monetary policy, inflation, and the labor market all remaining their top worries. In fact, almost 1/3 of the CFOs in that survey saying that they are delaying, scaling down, or permanently canceling investments due to economic and political uncertainties. Is that an overreaction? Maybe. But this was one of the fears for equity bulls who had been riding that wave of seemingly endless record highs after record highs that were increasingly showing ever narrowing participation. Coming into today, 1/3 of the S&P members were at 4-week lows, while barely 3% of the index was at 1-month highs.
You know, things have narrowed out there, so it has been a good environment the last couple of years, despite high rates. And of course, the U.S. is a shining star in the world in terms of economic growth. But when you look at the market dynamics, it is pretty narrow.
Yeah, it certainly has narrowed, Alex, and that really is a lot of the disappointment right now. And sort of what breaks us out of that? Is it going to be earnings? Is it going to be economic fundamentals? Or is it going to be Jay Powell and the Fed?
Yep, or just time. I don't know. So here's something interesting, and this sort of ties together the data that we've got. And this is the white line is the Citi U.S. Economic Surprise Index. So just a quick tutorial: if it's in positive territory, it means we're surprising data to the upside. Negative territory means we're surprising to the downside. And the purple line here is the S&P. And as you can see, you know, as you have economic surprises to the upside, you wind up having equities having a nice move higher. The divergence starts, though, in the beginning of May. S&P obviously grinding higher, while the U.S. Economic Surprise Index now is its lowest level since 2022. That's quite a gap. So, I mean, how does that wind up resolving itself? Are we going to be in a situation where we get negative surprise after negative surprise?
And what's the effect on the markets? As we kick you off to the close here on this Thursday afternoon, let's get right to it with Stuart Paul over at Bloomberg Economics, joining us right now on the back of 2 interesting economic reports that we got this morning. I don't know how significant they're going to be. We have weekless jobless claims, which you know are always erratic, but we're continuing to see those continuing claims go higher. Then you had housing data, also somewhat erratic, but still showing a trend line that seems to suggest softness there. Pick one. What's most important?
I think that it's probably weakness in housing starts that matters most. We're seeing, as you mentioned, monetary policy gaining quite a bit of traction in the real economy. Housing starts declining to the downside, declining about 5.5% month on month, and permits continue sliding. A big part of the reason for that is because the stock of new homes that are available for sale and just not transacting is pretty high. It's near early 2008 levels. So you should expect to see some headwinds for construction activity as new home inventories continue building.
At the end of the day, though, is it just about jobs? As long as the jobs market is okay, we can weather the rest despite the weak housing number?
I think that's the case, but we are seeing softening in the labor market. We are seeing continuing claims continue to rise. We are seeing that applying upward pressure to the unemployment rate. Breaching or hitting that 4% mark matters a lot, and we think that 4.2 to 4.3% is within reach for the September FOMC meeting, and that could be a deciding factor in determining whether we get 2 cuts this year or just 1, as the FOMC was showing in its previous dot plot.
All right, Stuart Paul over at Bloomberg Economics. A nice wrap up here of a couple of the big economic data points and I guess the reaction function, potential reaction function by the Fed and the markets. Let's continue this conversation right now with Rob Arnott, founder and chairman of Research Affiliates. Rob, thanks for being here on the program. Let's start with the macro and the fundamentals for just a moment here before we get into some of the individual market moves. I am curious that when you think about how the market has sort of assessed these economic data points and their assumption that at some point this is going to push the Fed to cut, do you think that's realistic?
Well, yeah, the Fed at some stage is likely to cut. The macroeconomic outlook is kind of mixed. It's interesting. If you look at PMI, Purchasing Managers Index, it's in the worst quartile historically. If you look at inventories, they're in the highest quartile ever. If you look at the slope of the yield curve, which is a terrific predictor of slowdowns, it's in its worst decile ever. If you look at rate of change of the cost of capital, which is a gauge that helps us understand whether companies are going to invest in new initiatives. That's in its worst decile ever. So with 4 out of 4 looking troubled, why is this economy chugging ahead? It's all on the back of a wealth effect from a bull market plus consumer spending. And so my question is, will those 4 indicators of slowdown have time to turn before consumer spending slows or before the market rolls over? The jury's out on that. I don't know.
Well, let me flip that on its head, though. Do you think the Fed will, be able to turn fast enough to maybe avert that? Or are we kind of past that Rubicon already?
We often hear that monetary policy has long and variable lags. What does that mean? That means that the impact of monetary policy on the macroeconomy is slow, and we don't know how slow. It can take a year, it can take 2 years. When you say slow and variable lags, another way to interpret that is maybe there's no impact anyway.
Well, that's what I was going to say. No, Rob, that's what I was going to ask. 25 basis point cut, what does that actually do?
It's not clear to me it does anything other than perk up enthusiasm, create a little bit of liquidity that often makes its way into the markets. And I don't think the Fed has the power to stimulate the economy. I think the Fed has power to stimulate bubbles, but not to stimulate the economy. So is the Fed going to cut rates? I think they urgently want to cut rates as soon as they have the economic cover to do so. A softening economy may give them cover to do so sooner rather than later. But if inflation surges back, which seems very possible, the commodities indexes have soared in the last 6 months. If inflation does reignite, then they can't cut. If the economy remains robust, then they can't cut. So they want to cut.
Yeah.
But they're just not being given cover to do so.
Rob, do you feel like there could be an offside risk that there's a hike in our future?
Absolutely. I would characterize the current outlook as not quite symmetric, more likely to see cuts than increases. But, if inflation does come roaring back, between now and year end, we are replacing months that were very benign last year. Every month, we wait with bated breath for the new inflation report. And the new inflation report exactly equals last month's inflation report plus 1 new month minus 1 old month. Now, that plus 1 new month, we don't know what it's going to look like. The minus 1 old month, we know exactly what it was. And if it was low, abnormally low inflation during the latter months of last year, then upward pressure is more likely. Upward pressure on inflation is more likely than downward. So we're of the view that 3.5 to 5 is the likely end of year inflation number. 3.5's not going to bother anyone. 4 to 5 is going to be seen as a real blow and would keep the Fed from cutting and might encourage them to hike again.
All right, Rob, we're just getting started here. Sit tight. We're in conversation right now with Rob Arnott over at Research Affiliates. We need to take a break, but he's sticking with us. And when we come back, we're going to take a look at what has effectively been an 8-month-long rally, a rally that started narrow, had really broadened out, but now has gotten narrow once again. And today, taking a breather, his thoughts on market breadth after the break.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets, which are kind of wide open. That's all good. Doesn't tell you what the future is going to be. I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. My view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
Bloomberg. Context changes everything.
This is Bloomberg.
All right, tech takes a little bit of a break today. You got Apple, Nvidia leading losses today in those mega caps. Rob Arnott is Research Affiliates, is still with us. Hey, Rob, is the money going to come out of tech and go into value and go into those areas, or is it just going to come out of the index altogether?
Well, it doesn't come out of anything because there's a buyer for every seller. What moves the price is more desire to sell, so that if the appetite for buying diminishes and the appetite for selling increases, the price falls. So it's not actually that money comes out per se. Markets move based on expectations and capital flows. Capital flows have been robust. That's been helping fuel a bull market. But back to your original question, value is cheap. Value reached all-time record cheapness in August of 2020, measured relative to growth, in each case measured relative to the underlying fundamentals. What's the relative price-earnings ratio, price-to-book value ratio, price-to-sales, and so forth. All-time record cheapness for value relative to growth in 2020, even cheaper than at the top of the dot-com bubble in 2000. We're getting back down to those levels. Value is approximately 1/8 as expensive as growth. That's an enormous spread. Normal is about 1/4. Value would have to literally double relative to growth just to get back to historic norms. So value is cheap. Then the question is, what's the catalyst that could move us back to that? An inflation shock could certainly do that. An economic shock could do that. Anything that increases investors' desire for a margin of safety will have them moving money into value. So I think value is the place to go, and I think non-U.S. equities are a lot cheaper than U.S. equities. The narrative is they're cheaper for a reason. Their growth rates are lousy, and that's true, but it's in the price.
But is it? Because but I feel like European stocks, for example, have had their moment a bunch of times where they're so cheap you just have to go and buy them, and it still hasn't worked out on a sustained basis. In fact, this time it feels like flows are coming into the U.S. from Europe because of political risk.
Of course they are. Of course flows are. Unless you want to chase performance, past performance, you don't go where the flows have gone. You go where the flows are going to go. Now, nobody knows where they are going to go, but it does make sense to ask the question, what's cheap? And is there an objective reason it should be this cheap? U.S. is priced at about a 70% premium, looking at conventional valuation multiples, about a 70% premium to broad international stocks, and about a 90% premium to Europe, and about 120% premium to emerging markets. Are emerging markets really going to perform so badly as economies that they deserve a fair price that's less than half the U.S.? Back in 2008, they were priced at a premium.
They were. And I do want to circle back, though, to just one word to knit it. And you used the word conventional valuation metrics. And I bring that up. I mean, we were talking with some folks a couple of weeks ago about kind of the need or the necessity that some folks feel that we need to kind of break away from some of those conventional valuation metrics, that we need something new to reflect new times. You've done that to some extent in research affiliates, although I know you're still.
Yes.
Yeah, well, talk a little bit about that because that's easier said than done.
Firstly, when you're investing in companies, you're not investing in a bunch of statistical attributes. You're investing in a business that has people, products, business strategies, and so forth. So the numbers are actually just a shorthand for all of that. But if you look at price to sales ratio, it's a wonderful indicator of what's cheap and what's not, but it ignores debt. And companies heavily burdened with debt, the price to sales ratio ought to be adjusted to take that into account. If you're looking at price earnings ratios, usually it's price to forward earnings, but forward earnings haven't happened yet. If you're looking at price to book, you're ignoring intangibles. And we're in an economy where over half of the value of a business goes up and down in the elevator every day.
Yeah.
And that's the intangibles. So if you can get measures of intangibles, you can make price to book a much more powerful measure. That's where a lot of our research has gone.
Yeah.
If you look at stock buybacks, they're a big part of the way companies reward their shareholders.
Right.
Dividends plus buybacks are a powerful metric. So putting all of this together, you can make better valuation multiple measures. But no matter what measures you use, value is about twice as cheap relative to growth as historic norms. And moving back towards historic norms would require value to roughly double relative to growth. That is very cheap. This is a time to average in to larger value allocations, not to run away.
All right, well said, Rob. We got to leave it there. We'll pick up this conversation pretty soon. I'm sure Rob Arnott over at Research Affiliates helping us kick you off to the close here on this Thursday afternoon. Coming up in just a second, a look at some of the big movers on the day. That includes Nike shares actually moving higher despite the fact that Williams Trading cutting its price target on the sportswear company. We're going to talk to the analyst behind that call.
All right, plus Elon Musk says in a post on X that Dell and Supermicro Computer will provide server racks for his new AI startup. We're going to take a closer look in our stock of the hour.
And McDonald's aiming to fight its competitors with lower prices. We're going to tell you what a $5 bill will get you at the Golden Arches. That's coming up next. This is The Close on Bloomberg.
I think I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Time now for our top calls. So look at some of the big movers on the back of analyst recommendations. And let's start off with Skyworks Solutions. B. Riley lifting its price target on the semiconductor stock to a street high, $130 a share from 96. It's the first time in more than 2 years that the firm has turned positive on the Apple supplier and its ability to generate sales, profit, and upside from AI data centers. Nevertheless, the share is fractionally lower here on the day. Next up, let's take a look at SolarEdge. A price target cut to $59 from $73 over at JP Morgan. The analyst saying residential solar demand in Europe, where SolarEdge gets more than half its sales, it's practically in a state of death. He's also cautious about near-term uncertainty related to elections and policy changes, though he is keeping his overweight rating, at least for now. Those shares down 7% here on the day. Now let's end things on Nike. The big swoosh getting a big bear hug over at Williams Trading, cutting its price target down to 75 from 81. The analyst there, Sam Poser, not feeling confident in Nike's C-suite and says it may have shot itself in the foot with too many layoffs. He also says that the lack of talent has led to push model manufacturing and increased promotional activity. Nike shares, which had been lower on the day, up about 1% here, though. It's, of course, one of the bigger laggards in the retail space on a year-to-date basis, and those are some of our top calls. And we want to stick with that last one there because it is a bold call, and I'm pleased to say the analyst behind it joining us right now. Sam Poser is senior equity analyst covering footwear and apparel over at Williams Trading. Sam, this call isn't completely out of the blue. I can just tell you from a consumer perspective, I noticed a lot more promotional offers in my email box from Nike, offers that I wasn't getting 2 years ago. I've also noticed that when I go to shop on their site, it's the same old stuff here. Is this the reason why we've seen kind of that sour sentiment around this stock?
I think so, and I think the controversy with the stock, however, is involved in what they've done. They've come out of things in the past, which we don't see happening today. I mean, we don't think that the company has the same mojo at today that it had, let's say between 15 and 17 when they went through some softness in most recent past.
Well, what do you think would actually get them there, though? Because, I mean, I feel like to a certain extent with these apparel brands, it's all kind of cyclical. One is up 1 year. Now you walk through the streets of New York, everybody's wearing Adidas Sambas for some strange reason. And next year they'll be wearing something else here. I mean, what can Nike do to sort of get themselves out of this rut?
Well, I think that, first of all, I think that trends evolve for a reason. I mean, if you look at, let's say, the Air Force One from Nike, it's been a very, very good shoe for a long time, or the Dunks. But now they have to pull back on the Dunks because I believe what happened was they were selling through very quickly. Some new people, let's say analysts within Nike, looked at it and said, well, the way this is selling, we could sell a lot more. Then they put a lot more in, and then all of a sudden they put in a little more than what the demand is, and all of a sudden you get markdowns and you get a problem. If they had kept it tight, we may not be. They need to still have more product evolution, but if they had kept it tight, we would be not seeing as many problems.
So Sam, how much of it though do you think is a macro issue in general? Like if consumers are stretched, they're not going to go to Nike, for example, they'll go somewhere else, versus they're just not coming up with the best product at the right time?
Well, I think that the macro is an equal opportunity annoyance in a good times and bad, and if you look at it, you mentioned the Samba, but we can also talk about Hoka's, Ons. We can talk about Asics, a lot of the Asics and Brooks and New Balance shoes that are doing exceptionally well. So I think this is all on Nike. This is not anything to do with macro.
What about talent? Like, what kind of talent then can they get?
Well, that's a bigger issue. I mean, they let go of a lot of senior people over the last few years, and those were people that really understood how the company worked. And you're dealing with the largest, one of the largest sportswear company in the world, and when you get rid of all that institutional knowledge, it isn't a good thing. And so, we think just a lot of decisions are being made for the wrong reasons. I heard from one retailer that, is getting higher allocations of product, and he seems happy about it, but he knows it could bite him if it doesn't work. And, so on paper, he's happy he's getting more, but from what we're seeing, about what's selling, you know.
Yeah.
I don't know. I don't know if he doesn't even know if he should have as much optimism as he does.
Hey, Sam, we appreciate it. Thanks a lot. It was a fun conversation. Sam Poser over at Williams Trading. We appreciate your time today. You guys are really up on your lingo, your sneaker lingo.
The sneaker lingo?
I have no game.
Yeah.
I have no sneaker lingo game.
Yeah, well, I mean, but that's gets to the other thing, too. I mean, you have to be in the zeitgeist, right, if you're going to sell these shoes, or at least get people to continue selling these shoes. And I have to say, Nike, I feel like it's just, they got in this rut. It was like they're just selling the Pandas and the Dunks and all that. And then, you know, kids move on. And let's face it, they're the ones kind of driving this. It's not, you know, those older people, you know, I wear the same.
This guy has really good shoes. Let's not even pretend. You know,
they're
he
not
has a
Nike.
closet.
Asics, so that was a new one to me. Did you know Asics were back?
Yeah, I used to run in them, but not anymore. Anyway.
There you go.
All right, coming up, we're going to get more insight into the credit market with Mark Okada, co-founder and CEO of Sycamore Tree Capital Markets. This is
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
Morning from our world headquarters in New York. I'm Manus Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
It'll probably take a year or two to get all the way back down to our 2% target. The good news in all of this is that the labor market has remained remarkably strong. Wage growth is still pretty good for workers. By some measures, might be still a little bit too high to get back to our 2% inflation target. So getting all the way back to 2% is going to take a little more time, but I'm confident that we're going to get there.
That was Minneapolis Fed President Neil Kashkari. This is the countdown to the close. I'm Romaine Bostic, and I think that's Alex Steele.
I'm Alex Steele. So the Kashkari kind of continues to double down. Obviously, he's been front and center in that like we're higher for longer, higher for longer, higher for longer.
Yeah, he's been a bit on a repeat, but we should also point out mostly the other Fed members seem to be saying the same thing, singing from the same hymnal. So I don't know if you take that as a positive sign that they're all on the same page, or you get worried that, well, they're not going to cut anytime soon.
Or at least preaching patience and data dependence. And our next guest says that higher for longer, he's been saying it for a while, will lead to a significant increase in Treasury auction sizes this year. He expects a 23% increase on average across the yield curve. So joining us now, Mark Okada, co-founder and CEO of Sycamore Tree Capital Partners. Mark, such a pleasure. So higher for longer, you've been saying it, you've been proven right. What are the opportunities? What are the risks associated with that?
Well, there's always both, right? So we'll start with opportunities. I think what's happened in this higher for longer environment, coupled with a massive increase in liquidity across markets. I mean, there is certainly, as we look out and look at deal flow, just markets in general, there's a lot of liquidity just sloshing around out there. So when you have the combination of very nice high rates and a lot of liquidity, the liquid parts of the market, the public parts of the market versus the private parts of the market, look very good to us right now. I mean, that opportunity of private debt versus public debt, private equity versus public equity, the tables have turned a lot.
Wait, I thought everyone loved private credit. I thought that was the jam. Like that was the new FOMO.
It is. It has been, and it has doubled in size in the last couple years, which always is a warning sign for credit people. You know, we look at that, we go, wait a second. But I think the dynamics of locking up your money for a long period of time is good when you want to avoid volatility, but it's not so good when you want to take advantage of volatility. And that volatility I'm talking about is what's happened with interest rates. So if for example, right, you're in the bank loan index, public market, very large, very liquid, earning 9.5%, 10%. That's around the 80th, 90th percentile as far as yield, overall yield. Like retirees don't eat spread, they eat yield, right? So yield at that sort of rate, that's great. I can get that in a public market with transparency and liquidity. If I don't like it, I can sell it. Or I can get stuck in a private debt fund and lock up my money for the next 5, 10 years.
But is that going to change, though? I mean, let's face it. I mean, one reason why we saw that money go into private credit was because the yield was there, at least before interest rates went up to 5%. So, I mean, the differential between what you can get in private markets versus in public markets was enormous. And now, I know that gap is narrowed, but you have a lot of people betting that rates are going to come down. Does that change the dynamic?
Well, again, in the backdrop, if you believe in higher for longer, which we do, and I really...
What does longer mean, though?
3, 4, 5 years. I mean, I definitely think this is more of the normal environment versus what we had before. A lot of the private equity and private debt was put on because of the zero interest rate world that we lived in. And in that scenario, it makes gobs of sense. It makes tons of sense. But in the world we're in now, where rates are higher permanently, you know, let's say rates come down and we go from 5.5 to 3.5. Where do you think the 10-year is going to be? It's not going back down to 2. You know, could that normalize at 5? Sure, that could happen. Those were all environments where what we're doing in liquid public markets would be quite attractive.
When you look at the money that's already in some of these private credit and private equity vehicles, now money for a lot of folks that's locked in and potentially for a significant amount of time here, and you talk about the opportunity costs that they miss. What sort of, I guess, gets them back on board, I guess, whenever their vintages come due, and assuming they actually get paid when they come due? which I mean, you laugh, but, you know.
Well,
some of you guys are sweeping a little stuff under the rug here.
Well, and as long as it's working, as long as the returns are there, that's not really, it's been a great, I'm not saying it's been a bad allocation or it's been a bad risk-adjusted return. What I'm saying is that relative to what we're doing, it's not so great. So the way you have to do that, if you are an allocator or a pension fund and you're in these allocations, you have to look to secondaries. Or you have to lever the fund to find the liquidity to do that. You got to sell something because they're fully invested. So, or some have cash, but I'm just saying from a relative basis, this mega trend of from private to public, I think it's durable. I think it's something that we will see much more of going forward. A lot of the PE guys now are focused on secondaries because people want to get out of their exposures, and that's an interesting dynamic. That's going to be something that's going to be much more durable as a return stream. But really, that's more private equity and venture and places that they're not getting any realizations, so they want to get out.
Yeah.
But I'm thinking it's going to start coming in private debt too.
Yeah.
So that's kind of the call.
So that's sort of where the opportunity then may lie, right? But what about the risks? I mean, with higher for longer, what gets hurt? What are you most worried about?
Well, it's always two things. When we're nervous, we're credit people, so we're always nervous.
For sure.
Yeah, we've been bullish, which is weird for credit people to be bullish, but to be the things to be worried about are always credit risk fundamentals. The U.S. economy looks pretty good, and it looks like it's in a period where there's plenty to worry about. Most of those risks were above ground. We know about Ukraine. We know about the politics that we're facing. We know about the deficit, and even with all of that, we've got a pretty good corporate economy. It looks pretty good, and it's
better than the regular economy. Or
which is a great,
which is good for the stock market.
To us. So I think from an opportunity set, that's going to be supportive of credit. And it's going to be supportive of yield, and it's going to be supportive of taking a little more risk, corporate risk in your portfolio. So that's all good. The risks that we see are obviously what's happened with covenants and what's happening with the way these cap structures are built and what's happening with all this liability management exercise that we talk about. It's not been good. I mean, if you look at the defaults that we've had, the recoveries have been low because of all the shenanigans, and a good active manager who knows what they're doing is going to avoid that stuff. That's, knock on wood, let's hope we can do that. But you get stuck in that stuff, that's a risk. That's definitely a risk, and it's out there, and you've got to do your homework, and you can't get complacent about the risks.
Before we let you go, there's another risk, which is we've been waiting for the wall of Treasury issuance to hit investors and for them to kind of flee and have that Liz Truss moment, right, where they push back against how much government spending.
Yeah.
Is that a risk?
Oh, totally. But I don't know if
when is it a risk? Like, when do you feel it as an investor?
When we pass the point where interest costs are bigger than the military budget, and we're in this place where it's $700 and something billion a day in interest expense. I mean, these are crazy numbers. One of the things I was looking at is if you look at the average maturity of Treasury debt, and you look back 5 years, and you look back now, it's about the same. So our Treasury Secretaries, Mnuchin and Yellen, did nothing to avoid this massive. They knew rates were going higher.
Oh, yeah.
They could have issued longer bonds and extended the debt.
Oh, yeah.
And so here we have ourselves where the cost of debt is rising dramatically for us.
Yeah.
Yellen's funding most of the government in T-bills, which is the most expensive part of the curve.
Yeah, preach.
And so that is definitely something where the rubber's going to meet the road at some point here.
Yeah.
And the bill's going to come due, and I think the only reason why we're comfortable is because the American exceptionalism continues. So let's hope it does continue from here. Because if it doesn't, we have a Liz Truss moment. That would be horrible. Let's say,
Okay, I'm going to ignore the last part of your comment. We're going to end on the American exceptionalism, to end on a high note. Mark, great to talk to you. We'll talk again soon. Mark Okada there, co-founder and CEO of Sycamore Tree Capital Partners. Now, while he was speaking, there was some breaking news involving Penn Entertainment. The shares were halted. They have reopened, and they are surging. Boyd Gaming said to be expressing interest in buying Penn Entertainment. This is according to a report by Reuters, citing people familiar with the matter here. Right now, Reuters is saying that the valuation would put it at around $9 billion, including debt. Bloomberg has reached out to Boyd for comment, and we have not gotten it yet. We'll stay on top of this story here. Stick with us. This is The Close on Bloomberg.
is next.
Fed was going to keep rating
World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices, and if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything.
All right, welcome back. It's time now for our stock of the hour. Keeping an eye on shares of Dell and Supermicro. The shares had been up more than 9% here on the day, at least for Dell, about 10% on Supermicro. The shares now making a little bit of a U-turn. This after CEO Michael Dell teased an AI factory with NVIDIA to power the supercomputer for Elon Musk. AI startup. Abigail Doolittle joining us now to talk a little bit more about this. And Abigail, I do want to start off with the rally that we saw early in the shares of both Dell and Supermicro. This all stemmed from an X post from Elon Musk where he suggested that that SMCI and Dell were going to help be supplying these racks. We then heard from Michael Dell himself seeming to confirm that here, and the shares got a nice pop out of it.
Yeah, huge pop. I mean, that was the big story this morning. And of course, it's the AI play. Everything right now, the AI craze. But now we've had this reversal, and that's a pretty significant reversal from being up 9% to being down slightly. Now, I think that some of it is perhaps it was priced in, because the fact that XAI is doing these server racks, that's not an entire surprise. To us, Dell and Supermicro Computer, that is new news. But if you think about it, and this is actually why I love technical analysis, this could be a piece of
we all love technical analysis.
We do. I'm glad to be spreading the message. But that other people down in Texas and California knew that this was coming. And so if you assume that everybody's buying with the information they know, that's trickling in. So now this could be a classic sell the news moment. And then when you combine it with some of the other stocks selling off, such as NVIDIA, I mean, we've just had such a hype around AI. I mean, this morning, NVIDIA was the world's most valuable company, up 108%.
Are they still the most valuable company now?
I want to look into that. I've been meaning to do that all day.
These things matter,
actually.
Abigail Doolittle.
They're switching around ever so slightly above $3 trillion. It is definitely the $3 trillion club. Some consolidation there is certainly helpful, but this AI theme, at some point, it's going to reverse significantly. This, I think, is more of a gentle pause.
It also feels like, oh, now we know it can also go down.
Yes,
I mean, literally, like that's something, right?
Yes, for sure. And we have seen that before. We have seen these, NVIDIA go down. In fact, between March, I'm going to pull up the chart very quickly. Between March and here it is. So between February, March, and then into April, the stock had actually been down, I think, almost 20%. But then to your point, actually more than 20%. To your point, Alex, out of that April low to the recent high, up 86%. So to be down right now, 2.6% on the day. There's been a 9% intraday reversal or intraday moves. That's healthy. It's putting some heft into that move up.
Yeah, absolutely. Here, Abigail Doolittle, a nice look here at our stocks of the hour. A closer look at Dell, Supermicro, as well as NVIDIA and the entire AI ecosystem. As we count you down to the closing bells, just about 14 minutes to go. Kara Murphy on deck, Kestra Investment Asset Management. That's coming up next on The Close on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future, or what? How do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
Market on close imbalance, the S&P 500, 2 billion to the sell side, the NASDAQ 100, 1 billion to the sell side, the Dow 30, 1 billion to the sell side, and the Magnificent 7, 870 million to the sell side.
Value is cheap. Value reached all-time record cheapness in August of 2020, measured relative to growth. So I think value is the place to go, and I think non-U.S. equities are a lot cheaper than U.S. equities. The narrative is they're cheaper for a reason. Their growth rates are lousy, and that's true.
All right, value may be cheap, but the big question is, where do you actually find that value? Rob Arnott kicking things off to the close just a little bit a while ago. Romaine Bostic here alongside Alex Steele with 10 minutes until we get to those bells. And maybe there is that search for value going on today here, particularly with the sell-off we're seeing in tech. But some of the buying we're seeing in some of the cyclical names and industrial names.
Yep, look at that. It's almost like 1 for 1 at that point. Energy up almost 2%, but Infotech down by 1.5%. Interesting, right? I did also want to, you see the Gilead news? That was fascinating. I mean, talk about like a biotech stock that really has some juice there. That basically we're looking at, 100% protection against HIV. That's amazing. I thought that was incredible.
Yeah, it's a nice pop in the stock there. Up about 8.5% here as we move closer to those closing bells. Some bright spots out there if you look for them. Let's get some insights out of our next guest, Kara Murphy. She's going to help take us to those closing bells. Chief Investment Officer over at Kestra Investment Management. All right, Kara, you came on a good day here because that big monster rally we've had, let's just say it's on pause for today. Maybe tomorrow this whole conversation will be moot. But there's been a lot of talk here about how that rally had really started to narrow. Whether we were going to get a broadening of that rally or whether the rally was just going to come to an end on its own. Do you see more life in it?
So this is a very challenging market rally to kind of chase, right? Because it's really being driven by just a handful of names. And we saw glimmers of that broadening out, which I think is very healthy long-term for the market. But one of the reasons why we're not super concerned about the concentration of the market is simply because because it's been so supported by really strong earnings. If you look at the top 10 names in the S&P 500 and you track their earnings contribution and their market cap contribution, the S&P 500, it's basically been in lockstep. So what that tells you is that there's a lot of fundamental underpinning for it.
Well, I'm just going to play devil's advocate for a second because the earnings have been phenomenal and certainly a surprise for a lot of investors. But if you take out, say, some of the top 15, 20 best performers that we've had, you're looking at S&P that's pretty, on an earnings basis, that's still somewhat shaky.
Yeah, and I think that's one of the challenges. You know, your previous guest was talking about growth versus value, huge discount for value right now. Absolutely true, and I think that does present a long-term opportunity, but growth has increased 20% earnings over the last couple of quarters while value has been negative. So at some point that will start to shift, and I think into next year we start to see more earnings power in some of these more cyclical companies, but so far it's just not coming through.
So it's not like a sell tech by energy, like it's nothing that simple.
I wish it were, right?
Yeah. I'm trying to boil it down for us here. No, that's not it.
So energy, we think, we actually had exposure earlier this year, partly as an inflation hedge. But we think now inflation is going to continue to subside on a slow pace, but we think the reason for being really overweight energy is a little bit less today than it was. So no, we don't think it's that simple, get out of tech into energy. But what you do need to do is if you have a portfolio that looks a lot like a core benchmark, understand that you are very heavily invested in growth and mega cap. You are much less diversified than you were a couple of years ago, and that's important to understand. You need to go elsewhere for diversification.
Can I just ask, this might be a dumb question, but if you do believe that inflation is coming down, does that get factored in to how you value some of these companies? Because I'm just trying to make sense of why we continue to see these pops up for companies that have already had phenomenal runs. Is that a big factor?
So it's not a dumb question at all. And I think it's really interesting because typically in a very high inflation environment, higher valued stocks are going to get punished more, right? Because you have to discount those future earnings. We didn't see that over the last couple of years. Instead, everyone piled into tech where valuations are higher. So I don't think, generally speaking, yes, that would be a concerning sign, but it hasn't worked that way in the last couple of years.
What other sort of derivative tech plays? Like if you wanted to be aware that like the Mag 7, you're heavily invested if you're in an index fund or something, how do you offset that?
So it doesn't have to get that complicated. You want to build in a little bit more exposure to value, a little bit more exposure to mid-cap. We think mid-cap in particular is a really nice fishing ground. Passive investors have kind of left it behind, and so there are a lot of really interesting opportunities. And then in fixed income, there are also opportunities to diversify as well.
Where in fixed income?
So, you know, another previous guest was talking about concerns within the Treasury market. We have concerns in the long end of the Treasury market for exactly those reasons of increasing government debt. So we would look for other areas within credit, and also active management is typically a really good place to be at these crossroads.
So I love that comment because then I get to play devil's advocate again. So I try to do this at home, but my wife kind of shuts it down. But I am curious, like everyone's talking about the debt levels, and look, I know historically on a percentage
So just keep in mind now in 5 minutes time, 4 p.m. Eastern, on the cash equity
world.
close today, Richmond Fed President Barkin is due to be speaking on the economic outlook. That's the Richmond chapter of the Risk Management Association. There is no text expected from Barkin, but there is a Q&A in just under 5 minutes time now.
So the reason why today is different relative to over the last 20 years, because I've gotten this question for many years, my answer was always, it doesn't matter. The American government can borrow with impunity. But during that time, just over the last couple of years, what you've seen is the debt burden, right? As interest rates have gone up, the cost of servicing that debt has really soared, and that's the big difference. A couple of years ago, we had the lowest debt costs that we've had since the 1960s. And if you just project on out, same growth in debt, same growth, or at same interest rates, it becomes really hard to manage. And it's also very, very difficult to bring down. And I don't care what party you're in, nobody's going to have an easy time bringing that down.
Well, we had Mark Ocado on just a little while ago over at Sycamore. He kind of talked about the same thing, the debt servicing costs, and how, I guess to a certain extent, I guess that effectively kind of steals money from other potential projects. And we know that a big part of the rally that we've had recently has been partly due to fiscal spending and the fiscal stimulus.
Yeah, and I think infrastructure is a great example, right? Where that's an area we know has been underinvested in for decades. The government has suddenly made it a priority, put dollars behind it, and it's been an important driver of construction spending around the country. So those dollars really do matter. And if you have to spend them in debt markets instead of in those projects, somebody's going to suffer.
Where in infrastructure do you like?
I think broadly, like when we look at construction, manufacturing, it is up by astronomical amounts over the last 2 to 3 years. We have not seen a splurge like this in so long. So you can find it in cement suppliers, in engineering companies, all along the food chain. I think there are a lot of opportunities.
All right, Kara, great stuff. Always great to talk to you. Kara Murphy right here in Studio 2, Kestra Investment Management, helping us count down to the closing bells. Just about 3 minutes to go until we get there, Alex. Stocks pretty much hovering where they've been now for roughly the last hour. The S&P down about 0.3%. The NASDAQ down almost a full percentage point, but transports up more than 1%. Dow Industrials up 0.7%.
It's really hard, though, to get a good fundamental read today. I know we have witching tomorrow, so we have a lot of options expiring. Quad witching, right? We have the rebalancing.
What's triple witching? They got rid of that fourth witch.
They did, right?
She was trouble.
But there's lots of witching involved here tomorrow. But the idea is it's going to be a liquidity event potentially, and it's going to be hard, I think, to get a clean read until we kind of get through that at the end of the day.
Yeah, and I think almost until you get into July, because then you got the end of the quarter coming up next week here, and then the holiday here in the U.S. Anyway, we are moving closer to those closing bells, and right here in the most important hour of the trading day. Stick with us, full coverage right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele here to take you through the closing bell as we begin our global simulcast to parse the most crucial moments of the day. Scarlett Fu here in the TV studio. I believe Carol Master came in today in the radio booth, and Tim Stenovec, who's always here, as well as we welcome our audiences across all of our Bloomberg platforms.
My digital twin.
Ooh, Carol, you always go dark here on these simulcasts here, and well, somewhat of a dark day in the equity market, at least if you're a tech stock. Red on the screen for the NASDAQ and the S&P, though a little bit of life for Dow Transports and Industrials.
Well, speaking of the tech area, the stocks
shortly expecting comments from Fed's Barkin.
Down more than the overall equity trade in a big way. Keep in mind, it's had quite a run since mid-April, up about 30%, far outpacing the S&P 500. But investors definitely pulling back on the semi space today.
Yeah, worst day for the stocks going back to May 1st. So, going back quite a bit to last month, Scarlett. We saw quite a reversal, though, in chip names today, which I found pretty surprising, especially given that we saw Supermicro higher and Dell higher after that news about the companies teaming up with XAI.
Yeah, you're hearing a lot of commentary like buyer fatigue, overbought conditions. It's worth noting as well that the eco data that did come out, and I like how Cameron Kreis, Bloomberg's macro strategist, put it, it's all B-list eco data, but they all generally point to, yeah, I know, they all generally point to softer activity overall. So that combined with what we've been hearing from retail sales, the data doesn't look supportive necessarily of further gains, at least in the short term.
Okay, looks like, guys, we're not going to get that 30-second record. This is a moment, not 30-second record.
All right, interesting moves here in the day. You are seeing yields slightly higher. Bitcoin trying to get its mojo back. But right now, all the activity in the equity market seems to be shifting, at least for today, a rotation to a certain extent into the Dow Jones Industrial Average.
The US Treasury adds Japan to its foreign exchange monitoring list. It says that no major trading partners have manipulated the currency and that Japan has been transparent on forex operations.
By about 14 points, right around that 54.70.
So again, the Treasury flags Japan's bilateral trade and current account surpluses.
Down more than 140 points, at 0.8%, and the Russell 2000 going to close out the day lower by 8 points, or about 0.4%.
All right, Romaine, back to the S&P 500 I go. A little bit of an even split, but a little bit more to the upside. 289 names in the index actually gaining some ground on this Thursday. 213 to the downside, and Scarlett 1 unchanged.
All right, let's take a look at the sectors in the S&P 500. There's 11 of them, but the biggest one, technology, is a real loser here on the day. That's the biggest red slice of the pie. The group off by 1.6%. REITs and staples also losing a little bit of ground. The best performers, energy stocks. 21 of 22 members are higher. Wow. And if you are looking at it from a valuation point of view, they are certainly cheap because they are cheaper on a PE basis than any other sector in the S&P.
All right, guys, the number one gainer in both the S&P 500 and the NASDAQ 100, Gilead Sciences. This went up about 8.5%, so just off its highs at its best levels today, up about 10%, but still a big gain. The company's experimental twice-yearly shot preventing 100% of HIV cases in women and adolescent girls in Africa It's the first successful big trial of what's hoped to become a powerful new drug regimen for fending off the virus. As you know, we have not found an HIV vaccine as of yet. So this is a big deal, and about 1.3 million people are infected with HIV around the globe every year. So this could be potentially a big step forward. We're going to actually talk with Dr. Anthony Fauci in the next hour. So curious to see what he has to say, because he's done a lot of work certainly in the HIV area. We talked about the stocks. Not a great day, but AMD did have a bullish day, up about 4.5% in today's session. Number 3 gainer in the NASDAQ 100. Piper Sandler making the chip maker a top pick in the large cap space heading into the second half of the year. So some upbeat momentum in that one. And this one for something a little bit different. I know it's a small cap company. I know. I always get a little nervous that you're going to jump all over me. Renpac Holdings, ticker is PAC. It was up 21% at its highs today, up at the close about 14%. Amazon announcing it has replaced 95% of the plastic air pillows from delivery packaging in North America with 100% recycled paper filter filler. So
that's why I haven't seen all the paper in the Amazon boxes, because of them.
I guess.
Wow.
Better than that styrofoam stuff.
I guess if I had been paying attention, I would have could have rode the rally there.
You'll learn something new every day. Those small caps, micro caps.
Okay, it's not a micro cap. In fact, it's the complete opposite. It's a mega cap tech company, but it is the worst performer in the S&P 500 today on a points basis. NVIDIA shares, they were higher by as much as 3.8%, but fell as much as 4.5%. They closed the day down by 3.5%. They were higher along with other AI companies after Dell CEO said that the company is building an AI factory for XAI with NVIDIA.
Where is this factory going to be?
It's, well, you know, we talked with Ashley Vance a little bit about it. We shouldn't really think of it like it's an actual factory, right? I think that's fair to say.
Okay.
Yeah.
What is it? Just
server racks.
Okay.
Yeah, those sorts of things.
Okay.
Widgets will not be made.
Widgets will not be made. There will not be making AI in this factory. There will be training.
Training. Okay.
They will be training the AI to come after us. To come after us.
That's worse.
Yeah, I think I'm pretty sure I saw a horror movie about this. But go ahead.
Speaking of AI, Qualcomm. Let's look at shares of Qualcomm and how they closed out the day. They did fall as much as 6.3%. They finished off their lows, still down by more than 5%. Biggest intraday decline going back to February comes after a Wall Street Journal report about Samsung's new AI laptop glitches. Link's equity strategists note that the report does not bode well for Qualcomm, which does supply the processor to these. The journal did report that Samsung didn't provide a detailed cause of the problem, but noted operational conditions on the laptops with the Windows 11 ARM and the Qualcomm processor. Also want to check in on shares of AutoNation, ticker AN. It's the largest automotive retailer in the U.S. Shares fell by 3.6% today. Auto retailers across the U.S. suffering a second major disruption in 2 days due to another cyber attack at CDK Global. It's the software provider that thousands of car dealers use and they rely on to run their stores. They do car repair orders. They do customer records, schedule appointments. They weren't able to do any of this stuff yesterday.
Yeah.
Still an issue for these companies. Shares down by 3.6% at AutoNation. And then DJT, Trump Media and Technology Group, shares falling today by more than 14%. The SEC did declare effective a regulatory filing that could dilute shareholders. And that made shares fall on the day.
Yeah, can you imagine though with AutoNation they have to like push paper around now? Like that's a whole different world than we were in before.
Keith Naughton described the software as part of the spine for auto dealership.
That's a good way of looking at it. I'm looking at the